As an industry leader for advanced construction and engineering solutions in e-infrastructure, transportation and building solutions, Sterling could deliver returns of 160% over the last 12 months. Fueled from different government programs like the Bipartisan Infrastructure Law or BIL and riding securely trend waves like the growth in the digital infrastructure market, they could steadily increase not only their revenue and sales numbers, but also their margins. In 2015, they committed to transforming the company from a provider of heavy civil constructions to a diversified service provider focused on bottom line growth, risk reduction and exceeding the peers' performance. That is a tough mission in this fiercely competitive market where other risks are also looming, like the cyclical nature of the construction market. In this analysis, we'll dig into the business model and the markets of Sterling, analyze the strategic position by doing a Porter's 5 forces analysis, and have a look at the latest financial statements to see how they are doing. We'll also check the valuation and do a discounted cash flow calculation. In the end, we will see if Sterling is a good long-term investment for us or not. Sterling has the ticker symbol of STRL on the Nasdaq Stock Exchange. They are working in the construction and engineering sector, were founded in 1955 and have around 3,200 employees at the moment. The headquarters is in Woodland, Texas, and the market cap sits at $2.7 billion at the moment. Sterling is a market-leading infrastructure service provider that is working for e-infrastructure, transportation solutions, and building solutions. The e-infrastructure solution is their fastest growing segment with the fastest growing revenue. Here, they provide and develop advanced and large-scale site for manufacturing, data center, e-commerce distribution, warehousing, but also power generation, especially when it comes to green power like solar or wind generators. In the transportation solution sector, they mostly provide infrastructure solutions in the Rocky Mountain states and Texas region. Here, they are working in the rehabilitation projects for highways, roads, bridges, but also airports, ports or rail stations. In the last sector, the building solution sector, they are working together with the nation top home builders like Pulte Group, for example, mostly in the nation top housing markets, which is Texas and Arizona. They provide concrete work solutions, which is, for example, concrete foundations for single-family or multifamily homes, or also parking structure, or even elevated slabs and all other kinds of concrete work. But that was not always the case. Before 2015, they were mostly working in the heavy civil construction area, and that made up more than 95% of their revenue back then. But then in 2015, they committed to transforming the organization and focusing more on high margin and high growth regions. How they managed to do this remarkable transformation over only 6 years, we can see when we look at the merger and acquisition timeline of them. Here we can see from 2015 up to 2022, a lot of acquisitions have been done. For example, Tealstone acquisition in 2017, Plateau acquisition in 2019, and Petillo and Kimes and Stone acquisition in 2021. Not only did they acquire new companies, but they also divested their partnership with Myers & Son, for example, in 2022 to focus more on their three strategic main segments. So here we can see they have a very clear mission in mind, and they also have a good strategy on how to achieve this mission, how to achieve this focus on their new 3 segments. We can also see the success of this transformation when we compare the revenue numbers from 2016 to the revenue numbers from 2022. Here we can see that in 2016 they had a bit more than $500 million revenue, and 94% of this revenue came from the heavy civil market. After the transformation in 2022, they now have a revenue of $1.7 billion, and they are much more diversified than before. Right now they make around 51% of their revenue in the e-infrastructure solution segment, 30% in the transportation solution segment, and 18% in the building solution segment. For the next years, they are planning to continue the same strategy, and they want to support organic growth, but also they are looking for strategic merchant acquisitions. They are looking here for new M&A targets that either add to their existing business or that opens up a fourth leg in either adjacent businesses or in infrastructure segments with a multi-year secure trend. Speaking about multi-year trends, when we look at this market report from KPMG, we can see that they identified 10 megatrends here. And I want to point especially to trend number 1 and trend number 5 here. Trend number 1 is called tilting towards territorialism and shifting allegiance. Basically, this means that in the current world of onshoring, of shifting allegiance, not only between countries, but also between different market players, it is very important to find the right partner for these projects. Trend number 5 is named Getting the Most from Digital. And that does not only mean building up the infrastructure necessary for this, like data center, power generation, but again, warehousing or distribution centers. But it also means providing digital solutions that from the time of the construction can already improve the operation later on. And that includes things like AI to enhance decision making, Internet of Things to enable predictive maintenance, for example, or also digital dashboards to drive monitoring and reporting. And that means that the designers, contractors, and operators are all on the same page, are all connected through these digital services they can provide. The US transportation infrastructure market is expected to grow with a CAGR of almost 5% from 2024 to 2029. So here we can see a significant growth. And if we scroll down here, we can see that most of the growth will come from road, bridge, rail, airport, but also broadband and climate-related investments. All these projects fit 100% on the e-infrastructure and the transportation segment of Sterling. And if we look only at the global digital infrastructure market, we can see that the CAGR until 2032 is expected to rise by over 23% even. The split of the growth in the different segments is very even, so there is not one segment that stands out significantly. It also shows how well these markets are doing when we look at the remaining performance obligation, basically the backlog of Sterling. Here are the numbers from the last quarterly report, and we can see that by end of 2023, we have very significant backlogs in all of these segments. And there is a very significant growth from last year in the e-infrastructure solutions, but also in the transportation solution segment. Only the building solution segment seems to be slowing down a little bit, but this is also by far the smallest one of Sterling. So the impact here is very minor. If you look at the total number of remaining performance obligations, the increase on a year-over-year value is more than 25% here. Let's look at the strategic position of Sterling by doing the Porter's 5 forces analysis now. First of all, I think that the threat of new entrants in this sector is medium. There are high capex requirements to enter the sector, and also you have to take care about licensing, but also regulatory know-how to enter these projects, especially the bigger government projects. So there is definitely an entry barrier to enter this sector. The threat of substitutes is medium because the competition in the construction sector especially is quite fierce. There are a lot of companies that are competing mostly about price and quality, and if you fall behind, especially when it comes to the efficiency of your projects, you might be replaced very quickly by a cheaper or a higher quality provider. The competitive rivalry in the construction sector is quite high. There are a lot of players here, and everybody is trying to stay ahead of the others from a technological point of view to be as price effective and efficient as possible in the end. The bargaining power of their customers is also quite high. Again, we have a lot of providers in this sector, so the customers can choose the best price and the best quality in the end. And especially when it comes to these bigger infrastructure projects like airports or train stations, the competition and the price pressure is quite high. The bargaining power of their suppliers is also quite high. First of all, these construction companies use highly specialized materials that is sometimes also only available on a local level, which lowers the offerings for these materials and of course increases the bargaining power of the suppliers, therefore. For some of these suppliers, it is also very easy to forward integrate their business and therefore basically become competitors of Sterling in some regards. So the overall market position of sterling doesn't seem to be too strong. It is a highly competitive sector. The customers and their suppliers do have a significant bargaining power. So it is hard for these construction companies to push their prices, to increase their margins, and to stand out amongst their peers. Before we have a more detailed look at the financials and the valuation of sterling, let's see how the stock did perform against the S&P 500 over the last years. When we look at the last year performance here, we can see that they did outperform the S&P 500 by quite a significant margin. Here we have a performance of 153% against 26% of the S&P 500. Over the last 5 years, the picture is very similar. Here we have a performance of over 600% of sterling compared to 100% of the S&P 500. And over the last 10 years, it looks very similar. Again, we have a performance of a bit over 600% from sterling compared to a 200% performance of the S&P 500. So here we can definitely see that, especially in the last 5 years, sterling had a quite impressive performance. When we come to the financials of sterling, first of all, looking at the sales numbers here, we can see that the sales trend is increasing on a year-over-year basis. This looks very nice. And also the expectations over the next 3 years is also increasing. When we look at the operating profit and the net income, we can basically see the same, but the trend for especially the net income increase is slowing down over the next years. And the analyst expectation is also that the growth trends for the next years will be quite a bit lower compared to the last years. What is very nice to see here is also that the net margin and the operating margin have been increasing on a year-over-year basis. And again, in the next years, it is expected to increase again, although on a slower level than what we had over the last couple of years. When we scroll down to the balance sheet here, we can see first of all that we don't see any leverage here. We don't see much debt at all from the company, but when I did the calculation from the numbers from the last quarterly report, I found that the leverage ratio, which is indicated as 0 here, very, very low level, but it's not 0. According to my calculation, it sits at around 0.1 debt to EBITDA ratio. So still very, very low. And that is remarkable, especially when we put this in context to the acquisitions they had over the last years. Here we can definitely see that they could achieve all these acquisitions without overloading their balance sheet with debt. They did finance some of these acquisitions by issuing new shares, and this did result in a stock dilution of 3% over the last 5 years. But still, I think this is not too bad, and especially the clean balance sheet really looks nice. When we have a look at the free cash flow and the revenue numbers, we can also see a clean growing trend for both of these values here. The free cash flow trend, the orange line here, we can see that for the majority of the last 10 years it was quite flat, and only over the last couple of years it did increase. This might be an outlier because the expectation for next year for the free cash flow is again that it comes down a little bit from the very high levels at the moment. So also when we have a look at the free cash flow growth numbers that we will see in a minute, I don't expect to see the same high numbers over the next years than what we had in the last 5 years. When we sum this up by using my checklist, we can see that the revenue growth of the last 5 years has been more than double than my threshold. It sits at a 13% CAGR. Definitely a green checkbox. The net income is the same. They sit at a 5-year CAGR of 42%, and the year-over-year value is even higher at 52%. Again, definitely a green checkbox for me here. The free cash flow growth set at a very, very high level, 75% CAGR over the last 5 years and 507% on a year-over-year value. Please keep in mind that the expectation, the analyst expectation, but also the expectation of sterling itself is that the free cash flow in the next year will come down a bit again. So this growth will definitely not continue over the long run. And if we look at the trend, the year-over-year value in all of these cases has been quite a bit higher compared to the 5-year CAGR. It is a bit questionable to me if they can really achieve the same growth number over the next years. And especially over the next 10 years, if we think like a long-term investor, I think these trends will all come down to a more reasonable value. The free cash flow yield sits at 12%, very high level. That is again attributed to the high growth that Sterling had over the last year. And I also think that this will come down again when the free cash flow comes down in the next years. The balance sheet of Sterling is very clean. They don't have much debt at all. The debt to EBITDA ratio sits at under 0.1 times. So there is not much leverage on the balance sheet here. Very nice to see. Sterling doesn't pay any dividends, so they don't get any checkbox for dividends from me in this case. And what we also saw is that Sterling could increase their margins and the return of invested capital over the last 5 years very nicely. Again, it is also expected that they can increase the margins over the next years, but I do think that the level of the increase will be lower than what we have seen over the last couple of years. Overall, the financial situation of Sterling does look very clean. The only hair in the soup might be the stock dilution of around 3% over the last 5 years again. But this is easily explained with the acquisition strategy they had over the last couple of years. So instead of taking on more debt, they decided to issue new shares to finance these acquisitions. To complete the analysis of Sterling, let's have a look at the valuation before we come to our conclusion. And if we look at the PE and the price to cash flow ratios of Sterling over the last 5 years, we can see that the price to cash flow actually sits at a very, very similar level to what we have over the last years. It's maybe even on the upper end, especially if we remove the outlier that we had here in 2020. The picture of the PE ratio does look a little bit different. Here we also see quite a stable value over the last 5 years. It is basically fluctuating between 15 and 10. And only over the last year, the PE multiple did increase. Right now, we're sitting at a PE multiple of over 20, which does seem quite elevated when we compare this to the recent history of Sterling. When we plug in these numbers to my fair value calculation, we come up with an average fair value of around $150, including my margin of safety of 10%. Without this margin of safety, the fair value would be around $173. So we are sitting quite above the current stock price. For the free cash flow and the net income growth numbers, I did use the analyst expectations for the next 5 years because it seems like these growth numbers are going down constantly over the next years. And by end of the decade, they are only expected to achieve mid-single digit growth. So if you think that these numbers are still too high, I can also plug in the lower end of the analyst expectations, which is around 3 to 5% free cash flow growth and net income growth. So let's use 4% here. And here we can see that the average fair value still sits at around 124 with my margin of safety. So still quite above the current stock price. I did use the current numbers for PE and for price to cash flow here, but we already saw that especially the PE multiple is a bit elevated right now. So if we go down to the 5-year average of around 11 here, the fair value also goes down a little bit. I did remove the Gordon growth model from this calculation because Sterling isn't paying any dividends, so we don't need to take any dividends into consideration here. When we look at the chart where Sterling is standing as of today, we can see that right now they have a stock price of around $85 right now, and they are sitting very, very close to their all-time highs. And if we look at the numbers from the last year in the monthly chart, here we can again see the insane increase we had over the last year. Before we come to our conclusion, if you did like the video so far and if you think this analysis was helpful for you, please consider leaving a like or even subscribe to the channel. It would help me out a lot and it would make me really very, very happy. Thank you so much. In the last 12 months, Sterling had a nice growth run fueled by government infrastructure investment and the secular trends in e-infrastructure and onshoring. Their income and cash flow growth and the constant improvement of their margins are exemplary and prove that the transformation they committed to in 2015 is definitely working out. Especially their strategy to focus on these high margin products and the horizontal expansion has worked out so far, and their backlog for the next years also looks very healthy and is increasing. Their balance sheet is very clean without much debt, even though the company ran an aggressive acquisition strategy over the last years. That is very nice to see. But there are also some risks to consider. With the fierce competition in the construction industry, there is always the risk of losing market share for Sterling, and also the risk of losing government contracts in their second biggest segment, the transportation segment. The cyclical nature in the construction industry could also turn the tide around quite quickly. The forecast for the income numbers over the next years still looks good, but on a lower level than what we have seen over the last 5 years. So, even though I do like the financials of the company and it also seems to be fairly cheap right now, as a long-term investor with a time horizon of 10 plus years, I don't like the competitive and cyclical nature of this construction industry. And I think that it's far from certain that Sterling can deliver the same results over the long run. As they grow in size, it would also get tougher and tougher for them to find fitting acquisition targets. For these reasons, I am not invested in Sterling right now, but I think that it can still be a good investment if you don't mind the cyclical nature of the industry and believe in the continuation of the growth story of Sterling. That being said, thank you so much for watching, guys, and see you next week.